Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Today is Monday, July 7th, 2025. It's good to be back after being away for 2 weeks. Um, we are back, and it's interesting, we had talked about how the market was squeezing into some tight ranges, and we're going to get to that, but it kind of followed through in some ways as we had kind of, suggested it may. So first, we're going to start with showing you some disclosures, and I'm going to also paste a few things into the chat you can check out. It's great to be there. Remember, we do today's state of the market. We look at indexes, the key sectors, and on Thursday we look at more nuanced trades involving stocks and individual groups with different kinds of narratives associated with the economy and things like that. So while you're checking those out, I want to just tell you that TradeStation is preparing to launch TitanX, the next generation of our trading platform. It isn't just a new model of our award-winning software, but a fresh trading paradigm that puts you in the cockpit like never before. TitanX will be available to customers as a beta soon. If you're new to TradeStation, you can join the waitlist at tradestation.com/titan-x, or see the description in this video, or also I have shared the sign-up link in the chat. All right, so I'll also start off with some standardized returns of the key ETFs we're going to be talking about. Now, remember that we also have a blog post that has some of the information we're going to be covering. That is tradestation.com. If you scroll down the page, you can actually see our blog post. It has fireworks on it. I'm going to get to that in just a second. So these are standardized returns. Go to tradestation.com, scroll down, and you'll see July starts with a bang as tech breaks out. And I think it's kind of interesting because, to me, tech is a third of the S&P. And I think it's pretty significant to realize that the kind of pace of things has actually, turned back toward tech, and there are some fundamental reasons for it. So I think it's pretty significant just to realize, we are talking about an important sector. That, most of the big major companies and the real drivers of this market are there. And there have been some interesting things happening with technology, financials, and industrials. And I think that remains something very interesting. We're seeing a little bit of a shift. We're seeing the consumer discretionaries become less important. Industrials and financials become more important. We're shifting from an economy based on consumer to more of an enterprise economy. AI is a big part of that, but it's not the only part of it. So you want to check out this article, you can do it here. Look at the S&P here. And I want to just say that we're kind of in a little bit of a confusing day now when you look at the news overall. I kind of look at this, so today Trump put 25% tariffs on Korea and Japan. And we know that I think it's actually the 9th when when officially the relief from tariffs that we had back in April kind of goes away and all that stuff. And you can check the news now. There's a lot of obviously moving pieces in it. And I look here at a balance of things, and to me, it's not really clear how to think about it. I mean, this could be the end of the tariff drama, or this could be the beginning of the next phase of it. And I think on one hand, we have this stuff happening, but at the same time, we also look out and we see the earnings are coming. Tech is broken out, and we have earnings as so this might be the kind of last hurrah of this kind of macro risk as we go toward toward earnings season. So it's an interesting thing right now, and I'm going to get to it. How the dollar is trading today, how gold is trading today. It seems like the market is at this kind of point where we're trying to figure out, is all of that macro, sell America, all that, is it over, or are we actually now going back toward a kind of crisis macro environment? And so I'm going to get to that. I want to just point out that to me, it's a real balance. And I think the market is actually showing an indecision between those two different kind of perspectives. You can decide for yourself. Do you think we're going to go back to the macro chaos, or are we going to return to the kind of back to normal tech and all that? Right now, the S&P with this breakout suggests that maybe we are heading back to the way things used to be, of tech leading, the S&P moving higher, and the kind of big macro fears not really being the catalyst. You can decide for yourself. I will point out, though, if you look at my article here, this one here, the chart in it, I actually kind of zoomed into it in this tab here, and you can see some interesting things. For example, the advanced decline line was making new highs last week. We had more stocks above the 200-day moving average. This is a special indicator we include. If you want to watch market trends on Thursdays, we share that with you guys. But it's interesting to see that when this line starts to rise kind of as a long-term thing, it tends to kind of become a momentum thing that can last for months. So I think this is actually something that's telling us here that we have potentially a real breakout here. The S&P breaking out above its old highs. We have tech leading. We have good breadth. We have, MACD turning higher. So these things here, I think, are potentially something that do kind of give a little bit more of a sense of the more positive environment here. And then also, it was just interesting for me today to see that Peter Navarro was back in the news. I've not seen him since a while, so I think we just have to watch out. If he's becomes more of a loud character going forward, I think that will kind of frighten people. I did see him today, and I think that's something also that he's kind of a bellwether for the kind of terror kind of narrative. So at the same time, I think it's also interesting that I'm going to get to the dollar and stuff. But one of the things that was really interesting to me also, look very quickly here at things like the XLK. I'm just looking at this on the daily chart. The last time we did our webinar was, I think it was somewhere back here. I think it was a Monday the 23rd was the last time we did this webinar. We had talked about this tight range, and really we've gotten the breakout as we kind of expected. It's interesting to me to see the tight range here. This is a daily chart of the XLK. You can see a tight range before the breakout. Then look at also at, for example, the industrials XLI. It was the first to hit a new all-time high. Look at this tight range before the breakout. Look at also something like the XLF also had a tight range, kind of, well, not as much of a clear tight. I mean, this is not as clear of a tight range. It's a different kind of price action. But I just wanted to point out that it's interesting to me right now to see that we've had those kind of tight ranges and those breakouts, and that could suggest that that we've established some support above at the old highs, and that is a potential kind of signal of continuation could be coming. So I want to just kind of point that out. The last thing I wanted to mention is that before we get onto the individual charts, is it's interesting just to see if you look at technology overall. I don't have it on this chart, but if you were to look at the relative strength of technology versus the overall S&P 500, this is the XLK on the daily. This is last July. It basically stalled here. Now the S&P made new highs all the way back here in the S&P was above its old high. So if you look here, I'm just very quickly, you can see this was July on the S&P of last year, and it went on to make new highs. XLK basically stalled July of last year, and it basically underperformed all the way until right here. We actually have a trading view idea on this you might want to check out, but the key point is that the XLK is starting, technology XLK is starting to show relative strength again. It's outperforming the index overall again. So this is something that I think is important. Basically, the entire market environment starting in July of last summer, when basically the Biden started cracking down on chip stocks, that was a peak for technology, and other areas brought the market higher. And then we basically managed for the S&P to make new highs late last year, early this year, without tech leading. And now we're seeing tech leading again. So to me, I think this is a really important thing to realize about the internals. It's a third of the index, and it is leading again. It's outperforming. It's making highs. So I think it's interesting just to kind of put that in mind. Actually, wait a second. This is daily. I actually had it set to 4-hour bars because I want to show you something here I'm going to get to with gold in a second. But first, let's just look at actually, let me just mention two other things about technology. Last week, HPE, Hewlett Packard Enterprise was allowed to purchase Juniper Networks. That was something that kind of also showed some potential positive regulatory environment in tech. The other thing is that some of the crackdown on the semiconductor equipment companies like CDNS. These are not equipment. These are the software companies, CDNS and SNPS. These are companies both in the S&P 500 that do software for chip design. They had a bunch of crackdowns by Trump, and then that basically went away. So the overall kind of behavior in terms of regulatory, legal, geopolitical, and tech has actually been getting better. Today we had some upgrades, not upgrades, but bullish notes, for example, on NVIDIA, demand for AI, all that sort of stuff, but just some interesting new notes coming out. So overall, the macro news mix now is still kind of giving a positive environment for tech. I think you have to realize tech is breaking out, and we have the kind of positive tailwinds behind it fundamentally. So I think we need to just realize that remains in place, and it's a third of the index, and it's a third of the S&P. So this could be a pretty significant thing to kind of keep our eyes on. So let's turn now to the S&P 500, the weekly chart here of the S&P. And to me, what's really interesting is you can see that one of the patterns we look at is we look for basically a close at a new weekly high, and that's what we had, and we had follow through, and now here we are, just kind of inside of that candle. And from my view here, this is like today is kind of meaningless. It's just like we're just putting in the time to wait for a little bit, just to kind of say we did it. I think that we need to have some just kind of sideways candles here on the daily, which let's take a look now at the S&P daily chart. And what we're going to see here on the daily chart, the S&P 500, I think that the key thing is this level here, basically. It's actually right here. This was a daily low, and it goes over here. It was look, see this level here. So basically, the level of 6175. So we have the high from kind of Wednesday. That this Thursday, July 3rd, was a half day, kind of a zombie drift for the holiday. But we are kind of trying to hold the high from July 2nd. But then we also have down to 6175, which was a low on Monday, June 30th, a week ago. So from my view here, this is kind of an area where we could just see some kind of sitting and waiting. Not much of anything. That's the daily. On the weekly, you can see where it is. It's that same line here. But the key thing to me is that we basically broke above that weekly closing high. It gives us a pretty good kind of confirmation, technically, of the breakout. When you combine it with the things we showed you in this other chart of the advanced decline line and these other things, there isn't much about this that really, argues. So far, there's not much evidence of anything, especially bearish overall. So 6175 is the level that, I think people are going to be watching. It's not to say it gets reached, but it might just be a period of a few days just kind of sitting and drifting somewhere above it with a lot of low volume, relatively unimportant price action. Maybe with, some kind of, headlines from Trump and the White House and tariffs and all that stuff, shaking things up a little bit. But the key thing amid all that turbulence and volatility, or at least whatever drama, I should say, because there's not very much volatility, but amid that drama, I think the key thing would be to watch 61.75, the low from June 30th, a week ago. All right. The cues here are very similar. And I think here we're just kind of, it's interesting. Also, you can see the kind of last week, the close. 2 weeks ago, this close around, it was actually 50-50 almost exactly. And we kind of held it. So you can see here in the weekly. And from my view, also, it's going to be a similar sort of thing here where maybe we just kind of hold above Thursday's price action. That's possible. Maybe we just test down a little bit more inside these candles. From my perspective, this is something where, we don't want to be trying to be overly kind of fancy about it. I want to just kind of point out you could get some scary Trump news, and then it does kind of dig down into these levels. But I think overall we are seeing essentially here the same sort of pattern of in this case it'd be the low from kind of July 1st. But from my view here, this is something where people are going to look for it. They're essentially holding here between kind of a low around 545 ish. In this range here around 550. It's just kind of sitting in this area. And it's more a question in some ways. It's not as much a question of levels. It's a question of time. We just have to kind of do our time a little bit, let some of the moving averages catch up. And then people may look, after maybe another day or two of sideways movement into slight downside, there may be more appetite to come in as we get further along and kind of see, okay, what the tariffs are going to be. It could be that today's tariffs kind of knock things down, tomorrow's tariffs or whatever, people just kind of shrug it off. So I think that's an important thing just to realize that it's about time here and getting through some of these headlines. All right, so the Dow here, the DJI, is essentially kind of stuck at kind of at these levels. And we had said that we saw this was something that had the potential to kind of struggle here. From my view here, I think the Dow, it has not broken out. We do have things like financial and industrial earnings coming. There is some potential, I think, around those events for it to, potentially attempt to break out. But I think we got to get closer to those events. We have the bank earnings and everything else next week. In fact, I think on this Thursday, we're going to show you guys a little refresher class on how to use TradeStation's award-winning platform to actually prepare for earnings season. But, most of those earnings are going to be, kind of next week and the following week before we really start getting into much earnings. So again, here may simply be a period of kind of sideways consolidation. The Dow's not giving us much of anything. Now the Russell, we had said, was kind of the weakest link, and it has had a little bit of a breakout. So, we did our webinar before. We had talked about this level around 2159. We said a close above it could bring more buying, and it did. See, we had a weekly close above it, and then a punch above, and then just kind of push to the upside. And I think now we're just kind of in this area where it's a lot of kind of not there's not a lot of really clear signals. This level up here, kind of 2280 to 2320 is kind of a level that I'm watching kind of potential resistance. But from my view here, this has very little trend at this point in time. It has not broken out, and I think it's interesting because if you look at the news, we're seeing less likelihood in some ways of Fed rate cuts. We're seeing yields move higher. So the Russell here is kind of, I think, back in the penalty box as an overall, as an index. It did this little technical thing that we had kind of mentioned might happen, closing above that weekly level. It did get that follow through, and now it's simply sitting. All right, the TNX is interesting here, the 10-year Treasury yield. This is something now where it's holding above 4.2. So, I mean, it made a higher weekly low here. And I think we just have to realize is that, the government just basically they just blew out the credit card. If you look at this fiscal thing now, and I think the world knows it, and it is a potential issue here for the 10-year. And so, this higher weekly low, and I think we have to kind of watch and see. This has been in a pattern, and I have to say, my long term. You have to kind of decide. Do you want to take a kind of glass half full or glass half empty perspective. And, I think when you look overall, there are reasons to believe that we have significant issues with yields moving higher over the long term. I've talked about this long-term downtrend that we broke. And I think if you want to be more positive on kind of the country and the economy and interest rates and stuff, you can say, well, inflation could, stall because of housing prices. You could say the Fed's going to cut. You could say those things, but then at the same time, if you want to take a negative view, you can find negatives like the fact that the deficit's going to get bigger, things like that, potential tariff risk to inflation. Those things are the potential negatives, and you have to kind of just decide which of those two kind of narratives you want to follow here. And I think right now, there is a spot here where if this becomes a new weekly low at 4.2. This could be a longer term problem for equities and risk assets. And I think that this is kind of behaving in a way now. We had kind of talked about at 4.65, that was going to be, potential resistance, and it was, but now we're kind of making another weekly, a higher weekly low. So from my view here, this is now in a spot where we could see yields run to the upside. And I think that remains, a potentially significant risk. It's not to say it's definitely going to happen, but if it does, let's just realize that this chart has potential for upside. When you look at it technically, it's broken this trend line. It has this basing pattern and a series of higher weekly lows. So even look back here, late April, higher low, then, so all these things right now, I think do create that risk of yields pushing higher. And then the thing is, that's not the most massive risk for the entire stock market. But it definitely, it could be potentially a risk for small caps in certain parts of the market. So just kind of bear that in mind. We could go back to an environment where like tech kind of does okay, but then small caps really struggle. So I think just realize here, we could be in an environment here where we can get some interesting potential downside trades in the Russell. And that can be kind of, an interesting trade sometimes when it just really struggles. We might want to be thinking about that in terms of downside in the Russell if this thing moves higher in the 10-year. Now, materials here, essentially, this is at a level where people might kind of see a peak, the XLB. So I want to just kind of point that out. This is now at this level from late December, and this is very similar to the Russell, to the small caps. And if you look at it, there's reasons to kind of see all the way across here as some kind of potential resistance. This whole zone here can just become a big, problem area. So I think right here, this is something where it's kind of done its thing, and it's not necessarily giving a whole lot more. You can also see it did have kind of a breakout through there that kind of happened, but overall structurally here, there's really nothing that is enormously positive overall for the materials XLB. That was now turning to XLC communications. XLC is more constructive. We've talked a lot about how this has had a very healthy weekly chart. And I think now this is something where it also kind of had this breakout, and now it's gonna people are gonna sit and watch for it to drift. Now remember, Netflix comes first, and I think we get Nvidia, not Nvidia. I'm sorry, we get Meta, we get Alphabet. So this is going to be something I think where this could simply be a zombie drift potentially in the communications XLC until we get to some of those earnings. We're going to talk about that on Thursday, so we'll just turn to it then. But this is something where it has given the breakout, but there's really no clear signals or anything here. And again, I think for something like this, it might be less about the chart and more about the calendar, more about passing the time. So that is the XLC communications. XLE. Now, this is something where, we had talked about the emergence of these lower highs. And, right now, you look at energy, OPEC increased production more than expected. And there's another article from Reuters saying that they're going to increase more aggressively again in September. Now, remember, Reuters, in my view, is extremely credible when it comes to OPEC. They have sources probably in Saudi Arabia and other stuff, but they have been accurate on all these news items. So I think right now I look at energy here, and this is something where I think people might just kind of look out and see there's just not, potentially a lot of positive sort of signals here. This might become a trend line if you look for a break to the downside here. So from my view here, energy is a spot where OPEC, it goes back to what I said about OPEC some time ago, which is essentially that OPEC is like, they're all just, it's like herding cats or something like that. There's different countries in there. I mean, all these like, I don't know. I mean, Kazakhstan and Nigeria, and they all want to do their own thing. And there is not a political consensus now to keep production down. I think that's really the key issue. And so even with this sort of stuff happening in the Middle East, but maybe that's kind of easing for now, because who knows? But the key point here is I think even the geopolitics of the Middle East is not the narrative now. The narrative now is the fact that OPEC is basically going back to just pumping oil. And so I think this is now setting up potentially for some decent downside. And we have this trend line here on the XLE that maybe we're going to get a trend line breakdown. This could turn into a decent bearish flag. So let's just kind of see if that happens here. I mean, I'm not sure exactly how to draw it. I'm not even sure. I mean, we'll come back to this, but I think that we have to realize is that there's some potential here for this to kind of return to its, difficult days. And the other thing I think about energy is that, don't forget, it's the only sector that is not broken out versus its old levels last decade. I mean, it's below its highs from 11 years ago. Every other sector is above its levels from last decade, and energy is not. So I think that's something to kind of be aware of. That is XLE. XLF. This is something I think here where it's just kind of, it had this, we looked at this tight range that it broke out above, and I think we have the same situation here where this could just kind of sit and kind of test down kind of to like somewhere between kind of 52, 51.90. Excuse me, this level, these zones in here, people could usually be looking for this kind of to sit and hold and consolidate. We have to be careful of this turning into a false breakout. That is, something of a potential risk. But at this point in time, with earnings coming and everything else, I think earnings will be the real tell on that. Now, industrials, interesting, also had this breakout from this tight range here. And again, people might simply look for it to kind of do some time and kind of holding these candles across here, potentially probing down kind of toward kind of 147, watching for that to happen. That's XLI industrials. Now, XL, you know what? I forgot to do gold. I'm going to go to this and do gold at the end. I apologize. I really want to look at gold and the dollar. That's XLI. Let's get back down to XLK. Now, XLK basically is, also tech here and had this breakout. And again, sitting and doing time, waiting here and consolidating. And I think that's really the thing to look at here in XLK. Today there was some interesting news. We did a trading view idea on Keysight Technology, KEYS. So I thought it was kind of interesting to see how it's kind of squeezing in a range here. Now it's just kind of stalling. Everything's just kind of sitting. But I think there's some interesting sort of, I think with technology here, we just have to kind of see if there are reasons here overall, I think, for people to have a belief that the market is entering a new phase of the upside. And I'll be honest, this is an environment here when you really look at it that you kind of have to decide for yourself, do you believe the macro risk of trade wars and the narrative coming from people like Torsten Slok and the narrative of what it's going to do to the economy, because some of them are quite dire. But then on the other hand, you know, is there one of those things where it's the wall of worry? And I think, as kind of traders and if you're looking to make kind of active decisions here, we can't really see that, but we have to realize that there are risks of things going both ways. To me, overall here, XLK is not giving any kind of clear bearish signals. It has kind of this confirmed breakout, and it would also be consistent here with wanting to see a period of sideways movement and consolidation. That's kind of where it seems to be pointing. Which would mean it would need some time here to kind of hold potentially, it's this kind of first day down and to kind of hold. And again, and this one, the July 1st low is potentially the level that people are going to be watching, which is down around on the Qs. I'm sorry, and that's the Qs, but on the XLK also, this kind of level from July 1st, you can see here the level basically on the daily from June 27th and July 1st, right around kind of 250 area. 249, 250. That is essentially the area here where you have some days of lows kind of established across there, right around 250 on the XLK. XLP is kind of interesting here. Let's go back to the weekly. XLP here, I think is interesting because it kind of held this higher low. And if we get into a little bit of a scary environment here, a little bit of downside, people might actually look for the XLP to push back up toward 84.5. And, we do have some earnings coming from some of the big companies like, Pepsi, Coca-Cola, Procter & Gamble. Those guys are going to be coming out in the coming weeks. So I think we have to realize here is that this might actually be an environment here where people actually look for the consumer staple ETF XLP to actually make more of a push to the upside here. It's interesting to see how it's been holding this level at 80 here. This is actually something that is not, I think, a bearish sign. It is held above this zone, and it's broken this kind of falling trend line, and people might actually be looking for more kind of follow through here in the XLP. XLRE, to me, this is, we had talked about essentially, this falling trend line, and I think it remains a problem for this thing. So I think we got to realize here that this is really struggling here, and it's failing to break out. The way it's just sitting at this level, this might be setting up for waiting, and if we see yields move much higher, this could turn into something kind of more bearish here. So I think we got to realize that the Real Estate Investment Trust. XLU is also just kind of sitting here, utilities. And I think here we have to realize between 80, we kind of said people wanting to be long probably want to wait for a clear breakout above 83. We have not gotten it. And so I think between 80 and 83, people are going to wait and watch. But this also, may have some risks. Say we get into like, yields moving higher. Utilities could be a problem in that environment. So I think we have to realize here is that these are in a tight range near highs with a potentially negative intermarket conditions, macro conditions. So XLU is stuck here. XLV remains just very problematic. There's all kinds of issues happening in this space between the Medicaid stuff in the budget, but then also a lot of issues with the health insurers like Centene, United Healthcare, Molina. We wrote about it actually in our article here. If you look at it, the biggest decliners last week were like these healthcare companies, Centene, Molina, Elevance. A lot of fundamental problems of increased usage of health insurance, which in turn is turning into profit margin, pressures. So I think this is something in healthcare we have to be kind of wary of here. Healthcare remains a pretty kind of difficult environment. I think if we actually look at this also, we might actually see something else on this chart, which could be, basically, I'm not a big believer in Head and Shoulders per se, but I don't know. That could look kind of like a Head and Shoulders to me. The idea that we rallied, higher, and then basically the market broke out, and then this thing is nowhere near breakout. So I think this is actually something here where healthcare is looking more problematic. And, again, things run before the news hits. Well, now we're in an environment where everyone's aging and the demand for healthcare is going up and all the jobs are going into healthcare. Well, you know what? Maybe healthcare ran and now people are just selling the news. Now that it's actually growing and it's in demand, people are like, I already bought that trade. I'm on to the next thing. And so I think we have to realize here, is it just because the overall macro environment for healthcare of aging population, all that stuff, would look bullish on the surface, it doesn't mean that the market thinks that. That could have already been priced in. And now we might face an environment of, wow, everyone needs healthcare. They don't like the way it's being done as a business. They don't like the health insurers. They're squeezing the health insurers. They don't like the drug prices. All this can now turn into something that goes the other way. So I think we have to look here and realize that the healthcare sector here, when you look at this, the chart is telling us things that are not necessarily very bullish. XLY, the consumer discretionary. To me, this is actually pretty problematic here because of the Tesla thing. And also because, like I said, we're in an environment now where industrials are strong, but industrials are kind of replacing consumer discretionaries. If you look at what's leading the market, industrials are tied into the AI data center build, all that sort of thing. Consumer stocks, we have not seen strength in consumers. We've not seen strong retail sales. We see problems in Tesla. We see problems in home builders with higher rates and all that sort of stuff. From my view here, we could be also at a spot where the consumer discretionary sector becomes more challenged for a while. So I think got to realize that here it's not breaking out, and this is also something that is potentially problematic to see. This could turn into a false breakout above where it was back at the beginning of the bear market in late 2021 when the Fed was hiking. This could actually be a false breakout that we saw in January. So let's just kind of be aware of that. And I think XLY is tricky here. I now have to jump over. I want to jump over to the gold miner, to the gold. Actually, first, let me just show you. This is XAU USD. I'm going to do a 4-hour chart here on TradingView. And it's interesting to me to look at this because it held this level down here around 32.45, and now we have a level around 3,300 that it's trying to hold. It kind of had a false breakdown and came up to that today. So I think this is something we have to realize here is that there are some, if you want to believe that we're going back to sell America, tariff crisis, scared of everything, people could be looking for some things to be developing here in gold. And one just mentioned that. Also, if you look at the GDX, the gold miner ETF, it has an outside day today. I don't know what to make of this. I want to just kind of point this out. Now, the other thing I want to show you is the dollar index on the weekly chart. Because, if you look at this, this is something of what like Elliott wave people would call, a completed trend. It has all, a completed move or impulse move. So, I mean, I think overall we have to realize here is that the dollar index has basically moved down a lot. And look over here now. On this, now I'm looking at the daily chart of the dollar index. Bring on my oscillators here. And you can basically see that we have a lower low, but MACD is making a higher low. RSI is making a higher low. So we have potential divergence on the daily chart here. And I just think we have to realize is that there's a lot of negativity priced in the US dollar. Meanwhile, if you look at the Fed, the CME watch, the CME Fed watch, we actually see that the probabilities. Look in the last week, we went from basically 75% chance of a rate cut in September down to 63%. The odds of staying the same went up dramatically. So I think that we're in a spot now where when you look at where we are with yields moving higher and other stuff like that, we might be in a spot here where the dollar moves higher. The other, the global economy is not looking great overall when you look at things like China or Europe. There's nothing that's really like, wow, these guys are doing great. Overall, the United States is actually performing better on a lot of metrics in terms of growth, in terms of overall things like that. One of the few countries that has not been cutting rates aggressively. So there is some risk here of the dollar squeezing higher. I want to just point that out because I think we have to realize is that it's become a very crowded trade to be short the dollar. And also there were articles recently about money flowing out of the global ETFs. So I want to just point out that I think we're at a tilting point here, a kind of balance between, continuation of the first half macro, crisis, end of the world, sell America, that could reassert itself. But if it doesn't, we could see the pendulum swing back to kind of back to normal, dollar rebound. Tech stocks are where people want to be. These things seem to be kind of taking shape. So at the beginning of a new half, a lot of stuff has happened. We had a very dramatic first half. And I want to just kind of point out that these two kind of options are kind of before us. And I'm not going to even try to anticipate which of the two happens. I want to just kind of point out that there are these two kind of scenarios in front of us. And that's kind of what we're seeing in something like the dollar index here, or like the S&P and tech breaking out. So those are the main things I want to talk about. We'll be back on Thursday for market trends. Don't forget to check out Titan X, and I'll see you guys on Thursday. Have a great day.